those are backwards, so those are after-tax dollars funded. After-tax. Tax-free growth still, but you pull out tax-free. Then we have our taxable accounts. And those are funded with after-tax dollars also.
Okay.
But they're taxed with us every year. So we get 1099s from the banks and the financial institutions. And when we pull money out of those, we may have to pay capital gains tax depending on that also. Any questions on the taxable bucket?
Yeah. Oh, what were the tax rules with the life insurance again, real quick?
Yep. And then that's the last one, so permanent value life insurance. Those are also funded with after-tax dollars because you paid your income taxes, but they grow tax-free, and you can get to your money tax-free.
And what?
And remember, every account has pluses and minuses.
So what's the minus?
The minus here is it's insurance. And anytime you have insurance involved, you're going to have a cost, and you have to qualify. Your downfall, your taxable accounts is all the taxes you end up paying. But the positive is liquid. Gets to it in 24 to 48 hours.
Yeah. 65
now,
or 58 or whatever.
Yep, these we can't touch till we're 59 and a half is the giant downfall. We're going to pay that 10% penalty.
So is it 59 and a half, or is it like, so what happens if someone opens up a Roth at 55? Do they have to wait till they're 59 and a half, or do they have to wait like 10 years or something?
No, it's always 59 and a half.
Okay, cool.
There is a rule, and you might be onto something, and I can't remember, that the money has to be there for a certain period, but I think if it is, it's 5 years. But most of the time, they're still, because of the way the Roth rules work, you can get your basis of a Roth tax-free anyways.
Okay.
So it doesn't really come into play ever. So when you look at this, right, so when we think about, and did we go over why tax-free growth is so important?
Yes.
Okay. And using the rule of 72?
Yes.
Cool. So then that's why, like, our taxable accounts are great for, like, money we need in the next 10 years. Because I don't have to worry too much as long as I don't have too much money there about taxes. It's kind of negligible. It still is eating away at my rate of return, but not, like, as bad.
Okay.
The life insurance, that's why it's much better 10 to 15 years down the road, because the insurance costs kind of eaten up after that point. So then it grows a lot better. And then these are great for when you're 60 plus years old. Now, when you start to think about that, then all these buckets should be kind of funded at the same time, right? And so we want to do that over time. Any questions on this?
No, I think I got it. I think.
Cool. So then when we think about money too, what we want, I want my clients to understand too, is a lot of people, when they start to think about saving money and investing, they just start to chase a rate of return. And that's fine. We want a good rate of return that we're comfortable with and that we're willing to take the risk to get. So some people might only be comfortable chasing maybe a 4 or 5% rate of return. Some other people might be willing to chase 10%. What I say is you have to kind of look at, so let's say your retirement money, right? You're 25 years old. You're a pretty conservative investor. You might say, Zach, I'm okay with 3 or 4%. But then it's my job to teach you, okay, but that's retirement money. You're not going to touch that for 30, 40 years. You can be much more aggressive with that.
Yeah.
So then once we start to think about that, we want to attach the goal of the money. So we pick the vehicle we're going to put the money in. Then we got to know when the goal is, the time frame is, and when we're going to use that money and how long we're going to use that money for.
What do you recommend? Sorry to interrupt. What do you recommend your 60-plus-year-olds do? Like bonds, CDs, treasury bonds, stuff like that?
It depends, right? like, if you've done the correct planning, like to give you my example, I will never own a single bond in my lifetime
Why is that?
because I have enough permanent life insurance that pays more than any bond ever paid.
What rate of return are you getting on the permanent life insurance?
Last year my dividend was 5.15%,
Okay.
and it's been 5% plus or minus 1.1% since 2000,
Okay.
which is how much has corporate bonds paid since then? Do you know?
Around 5%, right?
On average, 4.
4? Okay. All right, cool.
Yep.
So you're like, those are around like CDs, because I have a few CDs that are like 5.5 right now.
CDs right now.
Okay.
What did a CD pay you literally 3 years ago?
A lot less, but I've locked in like, I got like a 5-year and like a 10-year. My 10 year's at like a little bit lower, but yeah.
Which is fine. But here's the thing about CD. Do you know what the risk is? So, actually, this is a good chance to kind of talk about. So this is kind of where I wanted to go next.
Okay.
Is you have things that in your life you're going to want to have safe money and you're going to have risky money.
Okay.
Safe money is it can't go backwards.
Okay, but the risky money, you can get a little bit more risk trying to earn a bigger return.
Okay.
Okay.
But with safe money, you typically have lower rates of return.
Yeah.
Risky money is volatile, but you have higher rates of return usually.
Okay.
Safe money, I typically have a shorter time frame for. Risky money, I have a longer time frame for.
Okay. Oh, I did take some notes for this meeting that I did want to ask.
Yeah.
Okay, so this kind of goes with risky money. So with stocks, I saw on CNBC this clip was kind of going viral of like one of the Security and Exchange Commission's like officials were saying that like it was kind of talking about like some retail investors, like people who trade their stocks on their own versus like with a hedge fund. It's like the hedge funds are the people who really control the price, and that didn't really like make sense to me. Even like if like, because how did like GameStop happen if like a bunch of retail investors were doing that? And then also it kind of like had to deal with like hedge funds and the power of their money, and I was just kind of confused, and I wanted to ask about that.
So a hedge fund is like kind of like a mutual fund, all these different things. It's a pooling of money. A bunch of people pool money together. It's giant. Investment institutions. So maybe they're managing a teacher's pension somewhere. So they typically are more what are called market movers because they have to, like, Northwestern Mutual is a market mover. Northwestern Mutual could literally bankrupt Fidelity if they wanted to.
How?
Because of the amount of funds that they have in Fidelity. If Northwestern was like, hey, I don't want to use you guys anymore, they would literally be able to pull so much money away from Fidelity that Fidelity would crash. Like,
what is Fidelity like an investment company?
So they're just investment companies.
Okay.
So what an investment company does is like, so if I go to Fidelity and I want to buy Apple stock from Fidelity, I'm not buying it off the direct market. So I'm going to use Fidelity as my platform, or Robinhood's a good example of this too.
Okay, so Fidelity's like Robinhood?
Yeah, they're brokerage houses.
Okay.
That's what they are. They're investment companies. So like Robinhood, like if I put my money in Robinhood, let's say I put $1,000 there, and I want to buy GameStop stock on the Robinhood platform. Robinhood has to own that GameStop stock to sell it to. So Robinhood will buy that stuff. So that's when GameStop was going crazy. Why places like Robinhood had to put holds? Because they didn't own enough of the stock to sell it to people. So then they have to go to the market and try to buy it from a Fidelity or a Merrill Lynch that might not be using all their GameStop stock.
Oh, okay. So
So then what's happening is in hedge funds, like the GameStop thing was kind of like a blip, right? This is not a normal kind of thing.
Right.
What was happening in that situation is that a lot of hedge funds, looking at the underlying financials and leadership of GameStop, realized this is a dying business. Like, physical media is not a thing. They're not really, they don't focus on, like, they're not specialized in vintage gaming that people love. It's still new gaming then these companies are doing everything digitally and all these things, and your leadership's not willing to change your model. So what were they doing was they were short selling the stock. Do you know what a short sale is?
Yes.
So so they're short selling the stock to make money. Well, what happened was people were like, well, we don't want GameStop to fail. And then the retail people kind of got on Reddit and was like, okay, well, if we go buy a bunch of stock, then that drives the price up because it's just supply and demand.
Yeah.
So as they did that, that hurts the hedge funds because they're shorted on that position.
Yeah.
And they eventually have to get out, which then kind of does different things. So in very rare instances, yeah, you will have retail investors be able to change something.
So
all have to be.
You were saying with Fidelity and Robinhood, so they have a certain amount of that stock on hand, or are they just brokers? They're just a platform for which buyers and sellers can exchange? They do a bit.
So they're constantly having to get more and less and those types of things.
So was Robinhood themselves kind of shorting GameStop stock? Is that why they were limiting people from?
It's just they didn't have, right? It's a supply and demand thing. That stock's not unlimited.
Yeah.
Right? Yeah. GameStop might only have a total of 100 million shares out there. Of those shares, we could say, and I'm just making these numbers up, 60 million of them are actually owned. 40 million of them are kind of floating in this kind of space of they're able to be bought and kind of sold on average on a daily basis, but they're not being like held out. So you will have that kind of going on in the background, and Fidelity might own 10 million of those shares that haven't been sold.
So that's interesting. I didn't realize that. So that's why if you were to try to make the stock move up and down, it'd be harder because you have certain stocks that are just floating, like available to be traded.
Yeah, but it's not like, it's usually not a huge percent. Like, it might only be, most of the stock is going to be bought.
Okay.
Like, it might be only like, there's maybe 3 to 5% out there that's kind of floating.
Okay.
Like, I just used an extreme kind of example.
Oh, no, okay.
But, you know, that's kind of what's going on in that background. So then that's like when Robinhood, like, you know, because the retail investors kind of flock to Robinhood had to stop trading the stock, even knowing everybody else still could.
Okay.
Because they don't have physical stock to give to you. They have to be able to do that.
Couldn't they like go and like be like the broker and just buy, like just be like the transmission, just buy and sell, and whatever they could buy from other people or other companies?
Can they buy it? So
so that's why they were limiting buying but weren't limiting selling. Okay.
Yep. So what'll happen then in that case, like, okay, so say you know, they only own, let's say they own 5% of the total GameStop stock that they're kind of trading on their platform. But, you know, all this other stock is locked up. And Fidelity and Merrill Lynch and, you know, Northwestern Mutual and all these different companies that are brokers and doing things, they aren't willing to sell it to Robin because they're like, our clients have that.
Okay.
And if my clients aren't selling that, then I can't sell it to you. So it becomes that kind of, that's why they have to limit it, because now Robinhood's got to go out there and find more GameStop stock to sell their clients. And the companies don't want to sit, and the problem becomes is these companies, Robinhood doesn't want to sit on a ton of GameStop stock, because that's not how they make their money. They're not investors.
Yeah.
They are middlemen. They are moving that money around and charging fees, and that's how they make their money. The last thing Robinhood wants is a bunch of GameStop stock, and all of a sudden then their clients start selling it. Then they can't get rid of it to the other broker dealers because nobody's buying it. And now they're sitting on something that's crashing in price. So it becomes this weird situation.
Okay.
So
All right.
they're only ever trying to buy and use what they're actually doing. So that's why those things kind of exist.
Cool. All right.
So
I think I get that kind of.
Cool. So that's like it's a rare case that retail investors can really affect the market. Other times you'll see like retail investors, the market bump because of retail investors and things. It's usually not up. It's always usually down. It's because retail investors tend to be more of the knee-jerk reactions. So, oh, the market's down 10%, I'm going to sell because I don't want to lose any more money. Because they don't have the discipline the hedge fund managers do. Because the hedge fund managers have a goal and they know what they're doing, and they'll say, well, this is a small blip in the radar. I know my underlying strategy is going to withhold, and they hold. Whereas the retail investor will say, ooh, I don't want to lose any more money, get scared, sell out, which then crashes the market.
Okay.
Because there's more open shares on the market.
Gotcha.
So once we then start to think about that, and so we start to think about safe money versus our risky money, and kind of going back then to you're like, hey, what should a 60-year-old have? Well, it really just depends on their financial situation. Like in my situation, like I said, I'm never going to own a bond. Why would I want to own a bond? And actually, I'll bring up, I'll show you this. This is kind of eye-opening
Okay.
for most people. So